progress.
Hello, everybody. Ed Yardeni here. Thanks for joining me. Today is May 22nd, Monday, May 22nd. And as I've often said, it's amazing how time flies when you're having fun, at least. I hope you're all having fun and enjoying some of the benefits of the bull market we've had since October 12th. There's still a lot of controversy about that. There's still lots of economists who think that we're heading towards a recession. I noted in the morning briefing that there have been some of them talking about recession last year. Then they pushed it out to the first half of this year. Now it's the second half of this year. It's like waiting for Godot. Eventually Godot is going to show up. We still have a business cycle. We still have recessions, but we're getting a little tired of this recession story. And so given that several other economists have had no compulsion about pushing their expected recession out into the future, we're also going to bravely change our forecast. And instead of a 60-40% probability, 60% soft landing, 40% hard landing, we're now raising the soft landing to 70% and reducing the hard landing to 30%. One of the reasons is because a lot of the concerns we've had and others have had for a possible recession. I've been reasonable about it. I haven't dismissed the possibility of a recession. I think 40% is a pretty high probability. I think maybe it's too high given that the Fed has already raised interest rates considerably. I think they're done. They should be done. They're not going to take my advice, but I think the banking crisis, as we've discussed before, is equivalent to what, 50 to 100 basis point increase in the Fed funds rate, and the Fed should stay consistent to their storyline. The storyline has been that they want to get the Fed funds rate up to a restrictive level. I think the banking crisis proves that it is at a restrictive level. We still have the housing industry in a recession. We still have some areas of weakness in the economy. And meanwhile, the most important thing is inflation continues to moderate. It's turned out to be quite transitory in the goods side. Both durable and non-durable goods inflation's rates have come down substantially. And now we're just waiting for services inflation to moderate. And I think we are going to see quite a bit of moderation, particularly in the rent component. I know there's a super core inflation concern. We'll see how that plays out. But I do think there's a lot of disinflationary signs in the numbers. And that being the case, I think the Fed really just has to chill. I'm not in the camp arguing that the Fed will be lowering interest rates. I think if they stay true to their story, I think it'll work out. I think keeping the Fed funds rate 5.25% will continue to keep growth moderate without a recession. And at the same time, we'll continue to see inflation coming down. Let's look at some of the charts that we highlighted in the morning briefing today. And so the focus has been on, the recession story. How could we be reducing our likelihood of a recession when the leading economic indicators continue to signal that a recession is coming? And the leading economic indicators, LIE, peaked in February of last year. It's it's had a very, very good track record. So, saying that the leading indicators aren't going to work this time could very well turn out to be delusional. Could be delusional about this. On the other hand, maybe it's statistically speaking due to be wrong for a change. But if you look at figure 1, you'll see that it's had a pretty good record of peaking with a good lead time. Here's the lead time for it. And I think on average, the lead time has been 12 months. So if it did peak February of last year, that would indicate that as of February of this year, we should have been starting to see signs of a recession if you just take the average of all these. Of course, there's variability here. There's been a 2-month lead time, a 22-month lead time. So the average doesn't really mean much, but it gives you sort of a ballpark that on average, over the past recessionary environments, that's been a very good call. So why wouldn't it work this time around? Well, I should point out that so far there's no evidence in the index of coincident economic indicators that the LEI is right. Quite the contrary, it's gone to an all-time record high here in April. Here's another way to look at it, and here you can see just how long recessions last. I think the index of coincident economic indicators could basically replace the dating committee of the National Bureau of Economic Research, which gets together every now and then to decide whether a recession started and when the recession might have ended. I think the fact that the coincident economic indicators coincidentally peak at recession highs at the end of booms as set up by the dating committee, and that they bottom at the end of recessions is a pretty good indication that that's all we really need to really say what the business cycle's doing. So the coincident economic indicators consists of these four: payroll, employment. They're all rose in April. Real personal income, plus transfer payments, manufacturing, trade sales, and industrial production. I've been pointing out of late that this is the first number we get every single month, and it gives you a pretty good indication of what's likely to happen for personal income. Some of you may have seen our earned income proxy, which we base on the payroll employment data. It's worked awfully well as an indicator of wages and salaries, and that's looking good. Manufacturing and trade sales, a big component of that is retail sales, and obviously that's driven by personal income, which is driven by employment. And then when the payroll employment data comes out, we also get aggregate hours worked in manufacturing, which gives us an indication of what's going on in industrial production. And that's been flattish. It upticked in April, but that's been one of the areas of relative weakness in the economy. But that's a clue to why the LEI, the leading economic indicators, may be misleading. They're kind of heavily weighted towards manufacturing. And we have had sort of a manufacturing recession as consumers pivoted away from goods to buying services, and yet the overall economy grew because on balance it added up to economic growth. Let's look at this. This is the coincident economic indicators, year-over-year percent change versus real GDP. Notice they're on exactly the same scales, and look how closely the CEI on a year-over-year tracks what's going on with real GDP. And right now, CEI in April is up 1.7%. Real GDP in the first quarter was up 1.6%, hence no recession so far, but the LEI is still pointing in that direction. Here's the LEI versus real GDP, and that looks ominous, right? I mean, it's down 8%. The real GDP is up 1.6%. It suggests that we could have a real spill in real GDP. However, look at LEI, year-over-year percent change, versus the manufacturing PMI. It's very, very highly correlated, very closely tracks what goes on with the MPMI. So that's kind of the tip-off that the LEI has a manufacturing bias to it that we want to at least be aware of, recognizing that the economy is goods and services certainly has been doing pretty well of late. As a matter of fact, as we know, services is not very cyclical, with the one big exception of the pandemic, when services got hit a lot harder than goods. But as I've said before, the pandemic was a shock. There's been a lot of shock waves since the pandemic. And one of them is, one of the shock waves is that we had this boom in demand for goods coming out of the pandemic that then was followed by a boom in services as people spent less on goods. So here you can see the LEI versus real GDP. Again, it's somewhat disturbing. I'm sorry, let's do that again. This is the LEI versus real GDP for goods. And you can see that that correlation is even better. So yeah, the LEI is probably telling us that we still have some problems in the goods area of the economy, but there's other parts of the economy that are doing pretty well, including the consumer services, including non-residential construction, including public expenditures. Non-residential is because of onshoring to a large extent. And then there's public government spending on incentives for onshoring, as well as Green New Deals and more infrastructure. So that's all offsetting the weakness in goods. And in construction, we know, as we've discussed before, that the single family market is in a recession. Not so the multifamily market. And then, as I pointed out, construction employment's at an all-time record high, which just doesn't happen in a recession led by housing. So here we go. Let's look some more at these shock absorbers that have absorbed the shock of the and the shock waves of the pandemic. One thing that is I'm sort of close and personal to is I'm a baby boomer. I am still in the labor force, so I'm one of the few of us that are still here. There's about 11.1 million of us still in the labor force, so-called seniors. And not in the labor force is an all-time record high of, this is the red one, of 46.7 million. And altogether, that's 57.8 million seniors in the economy. That's a lot of people. It's a lot of spending power. The ones that are not in the labor force, a lot of them are retired. A lot of them are collecting Social Security. They're collecting pension benefits. And on top of that, they've saved. They've done quite well in the stock and bond markets over the years. And now they have a lot of leisure time. What do they do during the leisure time? They spend money, and they spend money on going out to restaurants. So we know that food and service retail sales have been soaring to all-time record highs. We all know when we go to restaurants, they're all doing extremely well. They go traveling, they go stay at hotels, they go on cruise ships. It's not for me, I get seasick, but my cousin who's my age is going on a cruise. So I see people around me doing exactly what I'm talking about here, spending more on services, and they have money. They have money from various sources, and they're spending it. I think that the kids are also spending it. I know this also from personal experience. I guess they figure that there's not much point in saving a lot of money since they're not making much. And dear old dad and mom will leave something after they've treated themselves to all sorts of trips around the world and good meals at good restaurants. I'm not trying to imply that everybody is like that among senior citizens. There's obviously lots of people that are struggling and aren't doing so well. But we're talking about a lot of people here, 46.7 million people that are basically, to a large extent, retired. And of course, as people get older, they need the healthcare system more. So we've clearly had a tremendous increase in demand for healthcare employees. We're seeing hospitals all over the country expanding, getting donations to do so. So here's payroll, employment, and labor-intensive industries. You can look at this more closely by yourselves here: hotels, motels, air transportation, restaurants, so on. These are all the kind of areas that I think are benefiting from the demographic profile of our population. And as you can see, that these labor-intensive industries have recovered nicely and now are at an all-time record high. So it's hard to have a recession when the labor market is creating lots of jobs. And as we know, there's plenty of jobs when we look at the job openings data, whether it be on JOLTS or Jobs Plentiful or the small businesses with job openings, there's lots of jobs. Another thing that's important to recognize is that wages relative to prices, real wages are starting to improve. Actually, they really didn't deteriorate that much for something like 80% of the labor force. 80% of the labor force is what's called production and non-supervisory workers, and let's call them lower wage workers. In real terms, they're making $22.60. All workers are making $26.30, and higher wage workers, which is everybody else besides the lower wage workers, are making $42.50. We calculated these numbers for higher wage workers based on the all workers and the lower wage workers. And as you can see, lower wage workers are actually held up pretty well. If it wasn't for the scaling, if I just put this on a scale by itself, it would look like an upward trend. And so lower wage workers have actually beat in price inflation, and that's been a source of purchasing power. It's the higher wage workers that have seen their real wages deteriorate. But then again, they've got wealth, they've got income. Hard to feel sorry for them when they're making $42.50 on average, and they certainly have other means to support their standards of living. So here again, here's the construction employment, all-time record high. Look at what's happened in the past. You know, you'd have recessions would, generally speaking, have housing join the recession, and you see that in construction employment. You see it here, but maybe this is about to roll over. But again, we have a very severe recession in single family. Multifamily is doing well, so that's a source of employment, but that can't possibly offset a recession in single family housing construction employment. So the other part of the story is all the money that the government is allocated for infrastructure spending. And I'll show you a chart that kind of is a nifty way to follow that. But here's another chart showing you that residential building plus residential specialty trade contractors, this is what they're employing, and that's not even going down. It's just kind of turning sideways. And then you have non-residential building plus non-residential specialty, which is still looking pretty good. We know that there's been a shortage of construction workers, so maybe as things have slowed down in terms of housing demand for new housing, that's just relieved the shortage problem, but it hasn't meant that anybody's had to be fired. And then finally, as promised, I think this is a pretty good way to keep track of some of the public spending and maybe onshoring that we're seeing in corporate America. And this is payroll employment, heavy and civil engineering construction. And again, back here, this took a huge dive. It actually was a lagging indicator in this situation, but it's had a big move to the upside, took a dive in the pandemic, and now it's, I think it's trending up to record highs given the amount of money that's being allocated to spending on onshoring and infrastructure and Green New Deals. Well, with that, I have one question. I'll be happy to answer that, and I'll take some more if they come along. Let me just, oh, by the way, where is Max? Oh, Max disappeared. Okay. I thought it was a little quiet. Yeah, Max usually snores in the background, but I guess he woke up, wasn't particularly interested in what we're talking about, and moved on. So, Joel, and again, anybody wants to throw a question at me, so far I just have one from Joel. There's a sense that the put-call ratio is low, indicating limited fear, but the OEX put-call ratio is quite high. Might this be where the fear is being hedged? Thanks. Yeah, it's a good point. I think the CBOE put call is still relevant, and maybe that's a bit of an offset. I have no problems with that. But generally speaking, when we look at all these various measures of sentiment, we're just not seeing a great deal of fear. The VIX is down. The spread between high yield corporate bond yields and the Treasury yield has been going nowhere fast, around 500 basis points. The sentiment index from the bull bear ratio has been running around 1.82. That's neither here nor there. I mean, usually a reading around 2 is kind of like between 1 and 3, 1 being where there's a lot of bearishness and 3 being where there's a lot of bullishness. As you may recall, I made a big deal about the readings below 1. I think at that 0.6 in the bull bear ratio back in June. I thought that was the low, June of last year, based on that reading, as well as our reading of the fundamentals. We're not technicians, but we dabble in the art. And then turned out that the market retested that low, got a little bit below that low in October 12th. But again, the sentiment readings were well below 1. And historically speaking, when you got that much pessimism, that's been a good entry point into the market. And so far, so good. Oh, we just had a slew of questions here. What do you think of the $1 trillion coin idea to get around the debt ceiling? I don't like it. It's a real gimmick. I think it would just set an awful precedent for unlimited financing of the deficit by printing $1 trillion coins. It's basically an argument for modern monetary theory. The idea being that we can finance any deficit that we want, as large as we want, with the Fed providing the liquidity by buying all the treasuries. And that's okay if your goal is to get full employment. And the MMT folks say, if you do see inflation pop up, then you just kind of whack-a-mole it with fiscal policies here and there. It's talk about delusional. I mentioned the word delusional before. It's a recipe for inflation. And we've seen what the consequences of that have been over the past year and a half, 2 years. It puts the Fed in a box of having to raise interest rates. And then it worsens the compounding of the interest on the debt, assuming that it's not all paid for with $1 trillion coins. Chris, thanks, Ed. Any updated thoughts on debt ceiling and default concerns, possible range of outcomes by asset class? I've kind of characterized it as a kabuki play. It's a political theater. They're playing the game right to the bitter end. Janet Yellen's already said that apparently there's an indication in the press that she's starting to think about who gets paid and who doesn't get paid. I mean, just if there is no increase in the debt ceiling, that doesn't mean that the government doesn't have any revenues to pay for its outlays. It just can't pay for all of its outlays. And there's lots of there's all sorts of reasons why the priority is going to be to pay the interest on the debt and Social Security payments, and then everybody else wait in line or take a ticket, and when the debt ceiling is passed, we'll pay you. So I think this notion that the government's going to default on its debt, that just doesn't make sense to me. I don't think Janet Yellen is going to do something like that. I don't really know Janet Yellen very well, though we both went to Yale. She went to Yale 6 years before I did. She seems like a very reasonable person. She's more liberal than I am, more conservative than she is. But I think she's already put out the trial balloon of, we're getting awfully close to the X date. And at the X date, the Treasury is going to have to make some decisions on who gets paid and who doesn't get paid. And I don't think they're going to default on the government debt. And I think a deal is going to be struck. Okay, this is from Gus. Ed, most economists are off on their outlooks. Are the models being used not accounting for the pandemic stimulus? Do they need to be adjusted as we move forward? Yeah, I think most economists still do stick to their models through thick and thin. And I think the pandemic was a major shock with lots of shock waves that has to be incorporated not so much into models, but just sort of empirical thinking, data-dependent thinking of how the economy is dealing with those shock effects. And so I think the models, are the leading economic indicators, and I've indicated why I don't think why they may be misleading. Within the leading economic indicators, another favorite is the inverted yield curve. And I've written quite a bit about how inverted yield curves do an excellent job of predicting a process that leads to a recession. Inverted yield curves start out with the notion that bond investors figure that might as well buy bonds here, even though they're below the 2-year, because 2 years from now, the 2-year might be lower and you might be just rolling over into lower yields. and these will turn out to be pretty good longer term yields to lock in. The idea being that if the Fed keeps raising rates, something will break. You'll get a credit crunch and a recession, and that's what will bring the 2-year yield down. Well, the inverted yield curves work brilliantly well in predicting that something would break. We have a banking crisis. The question is it going to morph into a credit crunch and a recession? I don't think so. But again, I'm fighting the statistical odds because the LEI has had a great track record of calling recessions, as has the inverted yield curve. But I think I've made my case for why this time that might be wrong and I might be right, but I could be wrong. We'll see. Okay, Joe, let me scroll down a little bit here. Joe, if the Fed does 2 further rate rises as speculated, would that change much in your view, or would you remain optimistic? I think I'd go back to maybe 60-40. The 70-30 is predicated on my belief that Fed officials, particularly Powell, get it. I think that little talk that he gave at the end of last week, he didn't use the word pause, but I think he indicated that we are things are kind of playing along the way he wanted them to. We're at a restrictive level on the interest rate, and he figures that the banking crisis, he admitted, is equivalent to some tightening. So I think he's kind of working his colleagues to get them on that same message, and maybe they'll just avoid using the word pause, but they might just say that the way things are going, it might be worthwhile waiting a meeting before proceeding with any more tightening. By the way, I've seen some speculation. Just I guess I'm about to kind of fuel the speculation that one thing they could do is go for a pause and increase the amount of quantitative tightening. I don't think they're going to go that route. I think they're going to go for a pause, whatever they call it. And I think that'll buy him some time to see what inflation does. And I think inflation is going to continue to moderate with an economy that's going to continue to grow, which is exactly what they wanted. I know that I'm supposed to be a contrarian and tell you that the Fed can't possibly be right, but I'm actually arguing that, they should pinch themselves and just realize that they may actually be getting the scenario that they've laid out in the summary of economic projections. That they've been projecting for a while. They get up to 5.25%, and that would do it without a recession, but a soft landing with inflation coming down. Okay, let's move on here. Anonymous, what do you think the long-term bonds will do from here if we get this soft landing? I don't have a hard feeling for the bonds up or down from here. I'm thinking 3.5% is probably just about right. So 3.5% plus minus 30, 40 basis points. I think we're going to be trading range bound. I think the bond market has already figured out that if the Fed keeps going, will increase the odds of a recession and a credit crunch. So maybe now is a good time to own bonds. But on the other hand, it's clear that the fixed income markets have been projecting a drop in short-term rates, which may be reflected in the bond market. And to the extent that the economy continues to hang in there and people give up on the idea of a drop in short-term interest rates, that might bias the bond yield to move somewhat higher. So if you're looking for an opportunity to buy bonds at a higher yield, there may be an opportunity in the short run. David, with the federal funds rate higher than inflation, by many measures, how long do you think the Fed will hold rates here before reducing the Fed funds rate? I think again, I'm staying true to the Fed's scenario, which I've kind of bought into, which is we're at restrictive. They want to get inflation down to 2%. We're still considerably above that, but we're moving in the right direction. Inflation, as you said, there are many measures, CPI, PCED, and there's wage measures. And on top of all that, real interest rates really should be measured relative to expected inflation. And to the extent that the Fed has managed to get some credibility here and expected inflation's come down, By some measures, it's down to like 3%. Then the Fed again is in restrictive territory and can kind of leave it there. I'll take one more question here. Brenda, historically, when financial conditions are as tight as they are there has typically been there's typically been a recession. This time around, there hasn't been any demand for loans. Do you think the lack of demand for loans will eventually result in an economic slowdown? I don't know. I mean, we're tracking the weekly data at the banks on loans, and the C&I loans and the commercial and the commercial real estate loans look kind of peakish, but they've been on an upward trend. Meanwhile, consumer loans remain at a record high, and C&I loans, well, I mentioned that. Real estate loans, believe it or not, at the banks are an all-time record high. They're not, I guess they maybe sit on these things and then find somebody to sell them to. No, I don't think there's anything in the credit numbers that I've seen so far that leads me to the conclusion that we've got a credit crunch, either because you can't get the money or because people have decided they don't want to borrow the money. I think that's happening in commercial real estate. I think certainly there's an example where lending conditions have tightened dramatically. And I think it's also a indication of the demand just has come down. We'll do one last one here. What are your thoughts about the big plunge in New York factory sentiment in May? Should that be of concern? Glad you asked. It was a big shocker, but there's 5 of these surveys. The Philadelphia Fed survey was not as shocking. It was still in negative territory, but it was kind of crawling back up. We got 3 more to go. And as I've said before, these 5 are highly correlated with the MPMI, the Manufacturing Purchasing Managers Index. And we're in a kind of a goods recession. We've talked about that before, but there's enough going on elsewhere in the economy that it doesn't add up that way. We'll take Gus. Gus says thanks, and appreciate. And I want to thank you for joining in to our regular weekly call here. And have a good week. We'll see you next week. Bye-bye, everybody.